What if I told you your portfolio could pay you 52 times a year instead of waiting 90 days between dividend payments? Have you ever felt the sting of watching your cash flow dry up while counting down to your next quarterly check? I've discovered a strategy using just 12 carefully selected stocks that delivers money to your account every single week of the year. Imagine handling your monthly bills with confidence or building your emergency fund steadily week after week. And no, you don't need to own hundreds of different companies or complex financial instruments to make this work. Did you know that most dividend investors are stuck waiting 90 days between payments from any single company? That's a long time to go without income if you're relying on dividends to pay your bills. Most people diving into dividend investing focus exclusively on finding the highest yields, but completely miss a critical factor that could derail their financial independence. Traditional dividend investing creates significant cash flow challenges that can undermine your financial security. When investing in individual dividend stocks, companies typically pay only 4 times per year, creating an inconsistent income pattern that makes budgeting extremely difficult. Consider what happens with a typical dividend portfolio of 6 quality companies. Your Verizon shares might pay in January, April, July, and October, while Johnson & Johnson pays in March, June, September, and December. This creates what I call the feast or famine dividend cycle. A real-world example makes this clear. An investor with popular stocks like Procter & Gamble, Verizon, and Johnson & Johnson faces 18 weeks each year with zero dividend income. Some weeks, 4 payments arrive simultaneously, while other weeks bring nothing. Monday, you receive $350 in dividends and then nothing for the next 24 days. This pattern makes using dividends as predictable income practically impossible. The consequences extend beyond mere inconvenience. Many investors keep excessive cash reserves idle instead of investing it, money that could generate more dividends. Others sell stocks at potentially unfavorable times just to cover basic expenses during income droughts. The psychological impact is equally serious. Behavioral finance research shows people make worse financial decisions when dealing with unpredictable cash flow. With erratic income, you're more likely to make impulsive purchases during feast periods and incur debt during famine weeks. This stress undermines the financial peace of mind that attracts people to dividend investing. Most financial advisors overlook this critical problem. They debate whether a 3.5% yield beats a 3.2% yield while ignoring payment scheduling altogether. They recommend sector diversification, but rarely consider payment date diversification. It's like building a car with a powerful engine but no gas tank. The yield looks impressive, but practical usability suffers. Some investors try adding more dividend stocks to their portfolio, believing 30 stocks will provide more consistent income than 10. This approach creates unnecessary complexity and often leads to owning mediocre companies just to fill payment gaps rather than focusing on excellent businesses. Others turn to monthly dividend ETFs, which offer consistency but typically provide lower overall yields and reduced growth potential. There has to be a better way to create truly consistent income without sacrificing quality or returns. The solution isn't higher yields or randomly accumulating more stocks. It's strategically organizing payment schedules. With just 12 thoughtfully chosen dividend stocks, you can transform erratic quarterly payments into a steady, reliable weekly income stream. This approach creates consistency without sacrificing quality or yield. The strategy I'm about to show you focuses on payment scheduling synchronization, a simple adjustment that makes the difference between retirement stress and true financial independence. Portfolio 1. The January, April, July, October payment cycle. Payment scheduling synchronization might sound overly technical, but it's actually the secret to transforming erratic dividend payments into a reliable income stream. What if you could get paid every week of January, April, July, and October using just 4 carefully selected stocks? This approach focuses on strategic selection based on when each company distributes its cash. Think of this portfolio as a precisely engineered timepiece. Like the gears in a fine Swiss watch, each stock moves in perfect harmony with the others, creating a reliable mechanism that consistently delivers income throughout the quarter months. Let's start with Walmart, a company that exemplifies dividend reliability. With an astounding 49-year history of increasing its dividend payouts, Walmart has proven itself through multiple recessions, market crashes, and economic upheavals. They typically distribute their payments during the first week of each quarter month. While the current yield sits at a modest 1.1%, you're really buying nearly 5 decades of consistency. Even during the 2008 financial crisis, when many companies slashed dividends, Walmart maintained its payout schedule, making it an ideal cornerstone for one-week payments. Moving to week 2, we have Altria Group with its impressive 8.2% dividend yield. Altria provides substantial income despite facing industry headwinds. The tobacco giant distributes its payments during the second week of the quarter months, creating a perfect complement to Walmart's first-week schedule. While some investors might question tobacco's future, Altria has consistently adapted to changing customer preferences and regulatory environments while maintaining its generous payouts. For the third week of our target months, W.P. Carey steps into the spotlight. This real estate investment trust, REIT, currently yields about 5.9% and follows a payment schedule in the third week of January, April, July, and October. What makes W.P. Carey particularly valuable is its unique REIT structure, requiring it to distribute at least 90% of its taxable income to shareholders. Its diversified property portfolio spans industrial, warehouse, office, and retail spaces across North America and Europe, providing stability even when certain real estate sectors face challenges. Completing our 4-stock portfolio is Cisco, the technology giant that rounds out our payment schedule by distributing dividends in the fourth week of these quarterly months. With a current yield of 2.9%, Cisco represents the tech sector's growing commitment to shareholder returns. While technology companies were historically known for reinvesting profits rather than paying dividends, established players like Cisco have matured into reliable income generators with competitive advantages in critical networking infrastructure. With an investment of approximately $8,333 in each of these 4 companies, totaling $33,332, your annual dividend income would reach about $2,829, distributed across 16 weeks of the year. During those weeks, you'd receive approximately $63.74 in weekly income. This approach creates consistent, predictable cash flow during these 4 months, making budgeting significantly easier. You've effectively secured weekly payments for nearly 1/3 of the calendar year with minimal complexity. Each stock serves a specific purpose in your income machine. From Walmart's dependability to Altria's high yield, W.P. Carey's real estate exposure, and Cisco's tech sector representation. Portfolio 2, the February, May, August, November payment cycle. The remarkable efficiency of our first portfolio is just the beginning. Did you know that one of America's most criticized dividend stocks, a company that slashed its payouts by 50% just last year, actually plays a vital role in creating consistent weekly income? Let's examine how 4 more carefully selected companies can fill another third of your calendar year with reliable dividend payments. With our January, April, July, and October weeks already generating income, now we'll tackle February, May, August, and November using another strategic combination of household names. These companies are specifically chosen for their payment timing to ensure you receive income during the weeks when your first set of stocks remains dormant. Let's start with AT&T, our first week payer for these 4 months. Despite the negative headlines surrounding its 2022 dividend cut, AT&T offers an impressive 5.2% yield, significantly higher than many stable dividend payers. Like a phoenix rising from its financial restructuring, AT&T has established a more sustainable dividend foundation. While it disappointed long-term investors by cutting its dividend in half, what matters most in our system isn't just yield or growth, but payment timing and reliability. Its restructured dividend appears to be stabilizing, and analysts note that despite recent challenges, the company remains a dominant force in telecommunications with solid return potential. For the second week of February, May, August, and November, we'll add Blackstone Group with its 2.3% yield. This alternative investment manager operates with some volatility in payment amounts, but offers substantial growth potential that purely income-focused investments lack. Blackstone serves as the portfolio's growth amplifier while maintaining its crucial second-week payment position in our calendar. As we bridge to the third week of our target months, we incorporate Apple. With just a 0.5% yield, Apple might seem out of place in an income portfolio. However, our strategy focuses on building a synchronized payment machine rather than merely chasing yield. Apple's modest dividend combines with exceptional capital appreciation potential, effectively delivering returns through multiple avenues while filling those crucial third-week payment slots in our income calendar. For the fourth week, we round out this portfolio with Caterpillar Inc. This industrial powerhouse offers a steady 1.5% yield and represents a different economic sector than our previous selections. Known for its reliability, Caterpillar serves as the portfolio's stability anchor, providing consistent dividend payments that complete our weekly coverage for these 4 months. When we calculate the income from this portfolio, assuming equal investments of $8,333 in each stock, totaling $33,332, the annual dividend income comes to approximately $791.59. While lower than our first portfolio's yield, we're optimizing for payment timing and portfolio balance. What's remarkable is how efficiently these 8 stocks work together. By combining both portfolios, you've secured income for 32 weeks of the year. Over 60% of your annual cash flow needs covered with minimal complexity. Each stock serves a specific purpose in your income machine, from AT&T's higher yield to Apple's growth potential to Caterpillar's sectoral diversity. Think about what this means for your financial peace of mind. Rather than experiencing the feast or famine cycle of traditional dividend investing, you're now receiving payments during 2/3 of the weeks in a year. Portfolio 3. Completing your weekly income system. While 32 weeks of income is impressive, what if I told you that the final 20 weeks of the year contain some of the market's most overlooked dividend opportunities? After portfolios 1 and 2 have secured most of our calendar with consistent payments, we still need to fill those remaining gaps in March, June, September, and December to complete our weekly income machine. Let's start with one of the pharmaceutical industry's heavyweights. Pfizer, with its substantial 5.7% dividend yield, makes its payments during the first week of each of our remaining months. What makes Pfizer particularly valuable in our system isn't just its generous yield. It's the company's rock-solid position in the healthcare sector. As a leading pharmaceutical developer, Pfizer's diverse product portfolio provides the kind of revenue stability that supports consistent dividend payments even during economic downturns, giving investors comfort during unpredictable market conditions. For our second-week payments, we're adding Johnson & Johnson to the mix. Though its 3.1% yield might seem modest compared to Pfizer, J&J brings something extraordinary to the table. Over 60 years of consecutive dividend increases. That's 6 decades of not just maintaining payments, but actually growing them year after year through recessions, market crashes, and global crises. This kind of reliability is precisely what transforms our portfolio from a collection of stocks into a dependable income machine that investors can count on regardless of market conditions. The third week of our remaining months belongs to Lind plc, which you might remember from its merger with PRAA. Don't let its relatively low 1.2% yield discourage you. Lind serves a specific purpose in our system. Following the corporate restructuring, Lind has maintained a moderate growth trajectory that complements our higher-yielding selections. Its third-week payment schedule fits perfectly into our income calendar, offering growth potential that appeals to investors looking to balance immediate income with future appreciation. Rounding out our system is Lockheed Martin, paying during the fourth week of March, June, September, and December. With a 2.2% yield and over 20 years of dividend increases, this defense contractor brings both growth and stability to our portfolio. What makes Lockheed particularly valuable is its unique business model. Long-term contracts with the Department of Defense provide exceptionally predictable revenue streams that translate into reliable dividend payments, offering a sense of security that many investors find comforting during volatile markets. Now let's look at the complete picture. When all three portfolios work together, your $100,000 investment, approximately $8,333 in each of the 12 stocks, creates something remarkable. You're essentially unlocking a weekly paycheck from your slumbering investments, averaging $63.74 every Monday morning. That's $3,316 annually without selling a single share of your holdings. Traditional income investing typically leaves you with feast or famine cycles where dividends arrive in concentrated bursts followed by weeks of nothing. Our system eliminates these dry spells entirely while providing diversification across healthcare stability, growth potential, and government contract defensiveness. When you know exactly when your dividends will arrive, you can plan your finances with confidence. Whether you're using this income for retirement expenses, reinvesting for growth, or funding periodic luxuries like travel or hobbies. So what have we really created here? A financial sanctuary designed around consistent dividend income. When you structure payments to arrive weekly, you're building psychological security that traditional investing significantly reduces anxiety, allowing for clearer decisions about your wealth strategy. That deposit notification creates a peace of mind that transcends the actual dollar amount. Imagine the relief of knowing income arrives every single week without fail. This system needs maintenance. Companies evolve and schedules shift, so conduct quarterly reviews. The minimal time investment yields tremendous confidence that your money works for you, creating reliable income without trading your time for dollars. Transform your sporadic dividends into a weekly win. Start building your dividend machine today.